Yes, so we were looking on this topic here, and the topic is conversion of a partnership into a limited company. So basically what we said is that this is basically the process through which now the partners in a partnership business will mutually agree to convert their partnership business into that, or basically to convert their partnership business into a company. And we said there are a number of basically reasons which can make the partners to make such a decision. One is because the company enjoys something called the limited, or basically the members in a company enjoy something called the limited liability. If you're a member of a company, the company is not able to pay its debt, then we say that you cannot be called upon to come in, contribute money to pay now the debt of the company. Though we say that if maybe your shares are not fully paid, you may be required to come in and pay the amount which is not yet paid on the shares which you hold. Number two, we say that a company also enjoys something called perpetual succession. So the life of the company, we say, basically is continuous, meaning that the life of the company is not affected by something happening to a member. If, for example, maybe one of the member is declared bankrupt, one of the member become of unsound mind, or maybe one of the member dies, the life of the company is not affected by that. But remember what we said is that in case of a partnership business, if something, for example, happened to a partner, like maybe one of the partner retires, one of the partner is declared bankrupt, or so on, then we say that that can lead now to the dissolution of the partnership business. So on the other hand, we said that the reason why the partners equally may mutually agree to convert now a partnership business into that of a limited companies, maybe for expansion purpose, purpose. So therefore, we looked on some of those particular reasons which may inform that particular decision by partners to convert now a partnership business into what? Into a company. But we said our main interest here is how we account for this conversion. How do we account for the conversion of a partnership business into a limited company? One, what we said is that once a partnership business has been converted into a company, we say that this particular partnership business here will be dissolved, dissolved. And therefore, from an accounting point of view, what we need to do is to cross off the books of accounts, of a partnership. And once we have crossed off the books of accounts of the partnership, then from there, what we need to do is to open the books of accounts of this new company. Because once the partnership business is dissolved, then what will happen is that a new company will be formed, and basically this company will be required to take over the business of the partnership, the asset, and also the liabilities of the partnership business. So therefore, what we need to do is basically now to do what? To open the books of accounts, accounts of the new company, company. That's why we said yesterday, we make two sets of accounting entries. The first set of accounting entries is to do what? To cross off the books of account of the partnership. And then the other set of accounting entries is meant to, or is for opening the books of account of what? Of the company. So we are not going to go through the journal entries, which we discussed yesterday. But first of all, you have to remember what we said is that once we are crossing off the books of account of the partnership, the main account which is prepared to do that is an account which is called a realization account. That is the main account which we prepare so that we can be able to cross off the books of account of the partnership. But on the other hand, to open the books of account of the company, we say that the main account which we prepare is an account which is called the business purchase account. The business purchase what? Account. This is the main account which is prepared to open the books of account of what? What refers to the company. So I think we can just look on what we record here in this particular account here. That is the realization account. But we discussed on this on the entries which are made in this account yesterday in form of journal entries. So one, we say that some of the the assets and basically the liabilities of this partnership business, automatically some of them or most of them will be transferred to the new company. Therefore, we say those particular assets which are taken over by the new company here, we said we debit them in this account. So the assets which are taken over by new company, they are debited in this account, and basically we say that we debit those particular assets in this account at their net book value, at their net book value. Remember, these are a ledger account, that is the debit side, that is a credit side. And remember also what I think this is something I mentioned in terms of how we account for this conversion of a partnership business into a company. This is not governed by any standard. Purely what we follow here is a concept or the rule of double entry. The concept or the rule of what? Double entry. In terms of how we account for conversion is not governed by any accounting standard, but we account for this using the concept of double entry. So therefore, assets which are taken over by the new company, they are debited in this account at their net book value. And then for the liabilities, which are taken over by the new company, liabilities taken over, we credit them in this account. Remember, I said liabilities always are taken over by the new company to their book value. Also, we said this account is also supposed to be credited with something called the purchase consideration. Purchase consideration. What is purchase consideration? Purchase consideration, we said, it is the amount of money which the partners of the partnership business will have to be paid by the new company as a result of having accepted to transfer the business of the partnership, the asset and liabilities to the new company. The partners must be paid some amount of money. So the amount of money they are going to be paid by the new company, refer to that as what? Purchase consideration. So that particular amount is credited in this particular account, credited in this account. Majorly, these are some of the items which are credited, are entered in this account, though there are some cases whereby you may be told the partnership business was dissolved, there were some dissolution expenses which were incurred and paid for by the partnership. They are supposed to be what? To be debited in this account. And then from there we balance this account, a balancing figure on this side. We refer to it as a loss on a realization. Basically, we say that the partnership business has been dissolved at a loss, or in other terms, the business of the partnership has been sold to the new company at a loss. But if you get a balancing figure on this side, it is a gain on a realization. It is a gain on realization. So meaning that the business of the partnership has been sold now to the new company at a profit. And this loss or gain is supposed now to be shared among the partners in this partnership business using their profit and loss sharing ratio. So basically that's how we prepare that particular account, which is known as the realization account. The other main account which we also prepare when closing off the books of account of the partnership is an account which is called the partners capital account. The partners capital account. This is the other main account which is prepared basically when closing off the books of account of the partnership. So in terms of how we prepare this account, first of all, we have the details column and columns equal to the number of partners, assuming you have two partners, partner A, partner B. The same case on the credit side, this is the debit side. On the credit side, we have the details column and columns equal to the number of partners, assuming you have two partners, A and B. Then what do we record in this account? First of all, in this account, we record the opening balance in the capital account. So always you'll be given the partners capital account balances. Record that as the first item on the credit side. The other item which we also record in this account is the partners current account. Partners current account. In the event we had a gain here on realization, that gain is supposed to be credited here. A gain on realization is supposed to be credited in this account here, because you have said that this particular gain is supposed to be shared among partners using their profit and loss sharing ratio. If we had a loss from this account, that loss on realization is basically supposed to be what? debited in that account. The other items which we debit in this account are drawings by partners. You may be given drawings by partners, we debit them here. Other items which we also record here are what? Assets, which are not taken over by the new company, but assets written off, either assets which are written off, or you may be told that there were those particular assets which were not transferred to the new company, but rather they were shared among partners. So therefore, assets not taken over by the company, they are either written off or they are shared among partners. We debit them in this particular what? Account. And basically, after recording all those items, you will balance that account. And basically, the balancing figure on this side, it is the purchase consideration, or basically we say is a payment to the partners. Remember here we said that the partners in this particular partnership business, they must be paid. They have accepted to sell their business to the new company. So they must be paid some amount of money. So that amount of money which will be paid to the partners, it will be the balancing figure in this account. And actually that amount must always be equal to this purchase consideration. You see this purchase consideration? Yes. So once you add the payment to these two partners, this must be equal to the purchase what? Consideration. So basically those are some of the main accounts which we prepare to cross off the books of account of the partnership. So once we have crossed off the books of account of the partnership, then what we do is we need to proceed and open the books of accounts of the new company. So when opening the books of accounts of the new company, we said the main account which we prepare to do that is an account which is called the business purchase account, And in this account of this account here, we basically record three main items. Remember, we looked on the journal entries for the same. You're not going to go through the journal entries again, but we're going to look on how do we prepare that particular account, which is called the business purchase account. So this is the main account which is prepared in order to do what? In order to open the books of accounts of the new company which has been formed, to take over the business, the assets, and the liabilities of what? Of the partnership. One, this particular account here is credited with the assets which are taken over. And we say that whenever the assets are to be taken over by our new company here, the new company take over those assets at their fair value, at their current market value. So mean that whenever the assets are to be transferred now to our new company here, they are revalued to their current market value. So we credit them in that particular account. And then on the debit side of this account, we first of all record the liabilities which were taken over. Taken over by our new company. And remember, in this case, we said whenever liabilities are transferred from the partnership to the company, liabilities are not revalued. We say that if a partnership business, for example, had an overdraft of maybe 5 million, you cannot revalue a liability. A liability is always transferred to the new company at its book value, because you don't revalue liabilities. And then also this account, we also debit it with the purchase consideration. Remember, this is the amount of money which our new company is supposed to pay the partners of the partnership business. And then from there, we balance this account. You can ordinarily this account will be having a balancing figure. The balancing figure may be on this side. If it is on this side, that balancing figure is a goodwill. Basically, what that means is that the partnership business or the company here purchased or basically acquired the business of the partnership at a goodwill. And this is something basically practically what happens whenever, for example, you have to buy an existing business. In most of the cases, you may be required to pay for a goodwill. So why are you required to pay for that goodwill? So the reason why you pay a goodwill is because there are some benefits which are associated with buying an existing business. Once you buy an existing business, we know that that business do have a number of customers. it's not the same with starting a new business. When you are starting a new business, you need to do a lot of marketing for you to get what? Customers. Maybe also whenever you have an existing business, the products, the services offered by such a business are already known. So you must pay for the goodwill because there are a number of benefits you are going to enjoy as a result of acquiring an existing business. So a balancing figure on that side is a goodwill, but there are some cases whereby you get a balancing figure on this side, which is known as a capital reserve. A capital reserve essentially is like a negative goodwill. It's like a negative what? A goodwill. So this goodwill is taken to the statement of financial position of the new company there as a component of non-current asset. Goodwill is taken to the statement of financial position of the new company as a non-current asset. Capital reserve, this is taken to the statement of financial position of the new company as a component of equity. As a component of what? Of equity. So basically these are some of the entries or how we prepare that particular account, which is called what? Which is called the business purchase account. So I think now with that particular recap, we can proceed and we look on a question. And I think we said we're going to look on one question and then I will give you an assignment. I'll give you another question you attempt. This is a topic which was tested last sitting. So maybe the chances of it being repeated again is very slim, but we are going to see. Once we have some more time during our revision, we're going to look on maybe another question. Another what? Question. Because these are basically a very, very common area in the exam. So I want us to look on a question which is here. But equally, before we look on this, it is important for me to mention that previously, before the revision or basically the review of the syllabus, under this topic of partnership, there are a number of concepts which were supposed to be covered. For example, previously or under the old syllabus, you were supposed to cover, or what was covered at a partnership or something, I think, to do with conversion of partnership business into a company, dissolution of partnership business, something which was known as full dissolution and piecemeal dissolution, and also amalgamation of a sole proprietorship business into companies. But all those particular concepts are not covered under the new syllabus. Under the new syllabus or under the current syllabus, as far as the partnership business is concerned, what you only need to cover is what? Is conversion of partnership business into a company. Because if you go through some of the past papers, you'll be able to see some questions asking on dissolution, conversion. So what you just need to do is to ignore those particular questions, because you need to know under the new syllabus there are a number of topics which were under the old syllabus which were dropped. Like you also be able to see some question on preparation of financial statement of banks, preparation of financial statement of insurance companies. These were topics which were covered under the old syllabus, but under the new syllabus they have been dropped, all of them. So therefore, that is important for you to note, or is important for you to note that. So I want us to look on a question which is here. Let's look on this question. This question which is here for which sitting? The sitting of May 2018. May 2018, and then I'll give you another question which is almost similar to this. So go to the sitting for May 2018. May 2018, question number 3B. So let's go through the question. We see what we are told. May 2018, question number 3B. So the question reads, 𝗙𝗏𝗃𝗃 and 𝗙𝗏 are partners in a partnership business, sharing profit and losses in the ratio of 2:2:1, respectively, after allowing for 10% per annum interest on fixed capital balance and commission entitled to a partner. So the trial balance extracted from the books of a partnership as at 30th September 2017 is set out below. So we are given a trial balance. We have in the trial balance land and buildings at cost, motor vehicle at cost, office equipment at cost, furniture and fixtures at cost, provision for depreciation for building, motor vehicle, office equipment, furniture and fittings. Then we have investment, we have goodwill, inventory as at 30th September 2017, account receivable, account payables, bank overdraft, accrued expenses, capital account for 𝗙𝗏𝗃𝗃 𝗙𝗏, and then we have the net profit for the year which ended 30th September 2017, and then we have drawings for 𝗙𝗏𝗃𝗃 𝗙𝗏, and then we have the current account for the three partners 𝗙𝗏𝗃𝗃 and 𝗙𝗏. So then we have some additional information there. Number 1 up to note number 3. So we are going to go through that. And then what we are required in our question 1 is we prepare the realization account, the partners capital account, and 𝗙𝗃 limited account to cross off the books of account of the partnership. And then Roman 2, we are required to prepare the opening statement of financial position of 𝗙𝗃 Limited, So basically what we required in our question 1 is we prepare 3 accounts to cross off the books of account of the partnership. Which are those 3 accounts? Realization, partners capital account, and another account which is called 𝗙𝗃 Limited. 𝗙𝗃 Limited, yesterday, if you can remember, is an account we refer to as the purchasing company account. The purchasing company account, and then Roman 2, we are required to prepare the opening statement of financial position of 𝗙𝗃. The statement of financial position of 𝗙𝗃 Limited immediately after taking over the asset and abilities of partnership. So let's go back to the additional information and see what we are told. Number 1, we are told that 𝗙𝗏 was the only active partner and was entitled to a commission of 15% based on the annual sales, or the annual, that is the annual sales revenue, which averaged to 20 million. So in this case, if we are told a partner or 𝗙𝗏 is the only active partner, it means that 𝗙𝗏 among the 3 partners was the one who was directly involved in the running of the partnership business. So if you are then directly involved in the running of the partnership business, you may be entitled to something like salary or even a commission. So and this commission, or basically these salaries entitled to partners, is always treated as an appropriation. And basically what you also need to note is that here in this topic, it is assumed that you did something or you have already covered something to do with partnership, because in the lower level, there is still, we have this topic which is covered, I think, in financial accounting foundation level. If basically you did financial accounting somewhere in your undergraduate course, you must have covered something to do with partnership. That is the assumption which you make here, because there is a number of things you need to know. For example, how do we prepare an income statement of a partnership? That is something I assume you know. When preparing the income statement of a partnership, basically we follow the normal format. We take what? We take the sales. This is something you need to know. We less the cost of what? Of sales, the cost of sales. We get what? Whatever you get here is the gross profit. We proceed and we less what? The expenses, and then we have now the profit for the year. But there is something you need to know here, that there are some items which are never treated as expenses, like salary to partners is not an expense. Maybe interest on partners capital account is not what? an interest. Sorry, is not an expense. So those are some things, some issues I expect you know. So therefore, once you have gotten this profit for the year, we know that a partnership business essentially is formed by partners in order to make and share profit. That's what we know, that partners come together to form a partnership business in order to make and share profit. So therefore, this profit is supposed to be shared among partners. Maybe those who are doing taxation, maybe have, I don't know whether you have covered something to do with taxation of partnership. So this profit, or once we have gotten this profit, there is something we come here and we add. One, we add interest on drawings. Drawings is basically the goods or maybe cash taken by partners from the partnership business. The partners may have agreed that once you go to the partnership business, you take some cash, you take some goods, you'll be charged an interest. So that interest, we don't treat it as an income here, but we come and we add it now to the profit there. Whatever we get there is the amount now to be shared among partners. So this amount is shared among partners in form of appropriation. So to this, what we do is that we come and we less appropriations. So when talk about appropriations, so basically this is the amount of money appropriated or basically distributed to partners. It may be in form of interest on capital. Interest on capital. We compute the interest on capital for each partner. The other appropriation is what? Is a commission. Like I hope you can see in that case, you're given a commission. It's still an appropriation. The other things include what? Include salary. Salary to partners. And then once you have deducted those three items from your profit there, your profit, or sorry, not from your profit, but rather from this amount which we have there, you may get a positive figure or a negative figure. So if you get a positive figure, then that is a share of profit. If you get a negative figure, that is a share of what? Of loss. And then that loss is equally supposed to be shared. That profit or loss is supposed to be shared among partners using their profit and loss sharing what? Ratio. So this is something I assume you know, because you're not supposed to teach this at this level. So what we are only supposed to teach here is only conversion. How do we account for conversion? In which case, I assume you have covered something to do with what? A partnership, and you know how we prepare that particular what? Income statement. For example, specifically, how do we distribute this profit? Because we need to have this knowledge here in answering that question. I hope you have seen in that question, there is something we are given like the profit for the year. So that profit must be distributed among partners even before you proceed to cross off the books of account of what? The partnership. So basically, that was just a quick recap of something I hope you already know, because that is something which is covered in the lower level. So let's go back to the question, Roman 1, or additional information number 1. We are told that Kidori is the only active partner. He is involved in the management of the partnership, and therefore he is entitled to the commission. So I think we can compute that commission as we have some few workings here. So number 1, we compute the commission. A commission to who? To Kidori. So in this case, you are told that he is entitled to a commission which is equal to 15% of the sales revenue, and you're told the sales revenue during the current financial year averaged to 20 million. So our figures, all our figures are given in thousands of shillings. I hope you can see that in our trial balance. So we're going to work with all our figures in thousands of shillings, not in millions, but in thousands of shillings. To now omit the last 3 zeros. So this will give us what? Is it 3,000? A commission of 3,000? A commission of 3,000. Is Kidori entitled to a commission of 3,000? Yes, a commission of 3,000. So that is the commission our partner was entitled to. Remember that commission now is an appropriation to distribute profit among partners. That will be one of the appropriations. So let's go to additional information number 2. We see what we are told. In additional information number 2, we are told that We are told what? We are told the partners resolved to convert their business into that of a limited company to be named 𝗙𝗵𝐻 Limited with effect from 1st October 2017 under the following terms. So we are told the partners resolved, they agreed to convert the partnership business into a company which is known as what? 𝗙𝗵𝐻 Limited. And basically you're told they made that decision, they made the decision to convert the partnership business with effect from 1st of October 2017. 1st of October 2017 is immediately after the end of the current financial year. If you go back to the information we have in the first paragraph, not in the first paragraph, just before, or the second paragraph, just before the trial balance, we are told the trial balance extracted from the financial records of the partnership is at 30th September 2017. So basically we know that a trial balance is prepared as at the end of the year. The books of account of the company are balanced at the end of the year, and once they are balanced, a trial balance is extracted. So mean that the partnership or the financial year of the partnership business came to an end on that date, that is September 2017. Automatically the next financial year was supposed to start on 1st of October 2017. So mean that the partnership business was to be converted into a company at the end of the year. There are some questions, although we are going to look on such questions maybe during our revision. There are some cases whereby the conversion may take place in the middle of the financial year. But maybe you're going to look, we have a question on that. We're going to look on that question during our revision. So at this point, we're not going to look on that question, but it is important now here for you to know that the conversion took place at the end of the year. So we are given the terms of the conversion in note 2, on point 1 of note 2. We are told investment comprised equity investment, which partners had acquired jointly, So if you go back to the trial balance, there is somewhere we are given investment. I don't know whether you can see that investment just below the asset up there. Up there we have assets, we have a provision for depreciation. The other item down there is investment. So in note number 0.1 of note 2, we are told those investment comprised of equity investment. So this is investment in shares. And we are told the partners had acquired those shares jointly. And acquired the shares what? Jointly. So then let's go back to 0.1 of note 2. We are told each partner was to take over a portion of the investment equivalent to their profit share. The investment had a market value of shillings 50 million as at 30th September 2017. So basically what that means is that this investment, which is an asset to the partnership, this asset will not be taken over by the new company, but rather we are told this investment is to be shared among partners. This is an asset which is not to be transferred to the new company, but it is to be shared among partners. Remember, you have looked on how we account for such asset, not taken over by the new company, but shared among partners. We have said those assets, they are supposed to be, in terms of how we account for such asset, we credit the specific asset account. This is something I gave you that accounting entry yesterday. We credit the specific asset account and then we debit the partner's capital account with the share of asset taken by each partner. So we're going to account for that when preparing now the capital account. So then point 2 of additional information number 2, we are told other assets and liabilities were transferred to the new company at the following agreed value. So what you're given there are the asset and liabilities transferred to the new company. We have added buildings, motor vehicle, office equipment, furniture and fittings. So, and you can see the values at which now the assets were taken over by the new company. Remember, you have said whenever assets are to be taken over by the new company, they are taken over at their fair value. So these are the values we are going to use when opening the books of account of the partnership. So not of the partnership, when opening the books of account of the new company, but when closing off the books of account of the partnership, we have said that we use the net book values. The net book values are the figures we have in the trial balance. And then from there, we are told inventory at a book value less 5%, account receivables at a book value less 2.5%, current liabilities were taken over at their book value, and then you are told goodwill are considered valueless and therefore was to be written off. Remember, we have said that those particular assets which are written off, still they are accounted for by crediting the specific asset account and debiting the partner's capital account. I hope you can clearly remember all the journal entries which I gave you yesterday, because this is what you need to remember. Point 3 of note 2, we are told the purchase consideration on the business purchase was agreed at 250 million. So this is a purchase consideration, the amount of money to be paid to the partners. And we say this particular amount of purchase consideration, we credit it in the realization account and then debit it in an account called the new or the purchasing company account. The purchasing company is the new company which is known as what? 𝗙𝗂𝐀. That's why you can see in Roman 1, we are required to prepare an account called 𝗙𝗂𝐀 limited account. So point 4 of note 2, we are told the partners were to become the shareholders. That ordinarily what happened once the partnership business has been converted into a company. So those who are partners in a partnership business automatically become members of the shareholders of the new what? A company. So we are told partners were to become shareholders. The company issued ordinary shares at par value of ⁻10 to the partners to satisfy the balance due to them on 30th September. So basically what that means is that the amount of money which was to be paid to these partners in the partnership business was paid to them by the new company in form of cash. Remember, you have said once the company has taken over the business of the partnership, the partners in a partnership business must be paid by the company. And ordinarily we say they are paid by the new company in terms of the new company issuing them with shares, issuing them with the shares free of charge as a form of a payment. And then finally, we are told, number 3, upon incorporation, upon the formation of the new company, that's what we mean by incorporation, the formation of a new company. Upon incorporation, the new company issued debentures at par value, carrying interest of 14% per annum. And then you're told the cash proceeds from the issue amounted to 50 million, were used to purchase additional stock of raw materials, 15 million, and accrued expenses were settled in full. So these are now some transactions which were taken over, or these are transactions by the new what? Company. So we are going to account for them when opening the books of accounts of what? Of the company. So, and I think with that now, we can prepare the account which we are required. In fact, in this question, we don't have a lot of working. In fact, I think we can just do away with this working here so that we have enough space to prepare now the account which we are required to prepare in Roman 1. In Roman 1, we are required to prepare basically 3 accounts. The account which is called the realization, the partner's capital account, and what we refer as the 𝗙𝗂𝐀 limited account, 𝗙𝗂𝐀 limited account. But I think before we do that, there is something we need to do here. Before we close the books of account of the partnership, there is something we need to do. So if you go back to the trial balance which you are given here, you'll be able to see that we are given the profit for the year. The profit for the year of the partnership. Now, the first thing we need to do is to distribute that profit among partners. We need to know how was that profit supposed to be shared among partners, though this is a part of the working. And once we have done that, whatever is shared among partners is something we are going to take into account in preparing the partners' capital account. So therefore, before we prepare those particular 3 accounts, let's first of all share out or distribute that profit among partners. And we do that by preparing something called the appropriation account. For those who did, but definitely I hope all of you covered this topic of partnership somewhere, you know what is an appropriation account. An appropriation account is part of the income statement prepared by the partnership. And basically this account is prepared to show how the profit reported by the partnership business is supposed to be distributed among partners. Actually, the appropriation account, I hope you can remember this format which I've given you here. The appropriation account is an account which is prepared to show how the profit for the year is supposed to be distributed from among who? Partners. So therefore, when preparing this account, always we start with the profit of the partnership for the year. So, and I hope you can see that profit of the partnership from the trial balance which you're given, and that profit is 91 million. So if you can remember, ika format nimewapea hapa, we have said that this profit here, there is something we need to add, and that is something called the interest on drawings. The interest on what? On drawings. So we need to check what the partners charged interest on drawings. So that information, or do we have such information? No. In the additional information, or sorry, not in the additional information, but rather in paragraph 1 of that question, we are told 𝗙𝗏 𝗡𝗃 are partners in a partnership business, sharing profit and losses in the ratio of 2:2:1. That is 2:2:1 respectively, after allowing 10% interest on capital. So that is information about sharing of profit, the interest on capital, and commission. And what? Commission. So, and then in the other paragraph there, we are given the trial balance. We know in the additional information, there is nowhere we are given information about what? The interest on drawings. So mean that the partners were not charged the interest on drawings. Now, whatever you get here is the amount now to be shared among partners. So, and what then we do is that we proceed and we less now the appropriations. We less now the appropriations. So basically, I've said appropriations. This basically how this profit is supposed to be what? To be shared among partners. This how the profit is distributed to the partners. I've said here we list a number of items. The salary to partners. Are the partners in this question entitled to any salary? Do we have any information about the salary which the partners are entitled to? No, there is nowhere we are given such information. So therefore, we don't have salary to partners. Those are some of the items you should list here. Salary to who? To partners. Maybe I can just note them here for you to be able to remember. So we don't have interest on partners. So the other item which we list here is commission. To who? To partners. Commission to partners. We know we have 3 partners. You should come and you take into account the commission to the partners. But we only know, or basically we know, it is only one partner who was entitled to a commission as per the additional information number 1. So we only know, or basically we know the only partner who was entitled to a commission was Kidore, and he was entitled to a commission of 15%. 15% of what? Of the sales. And you're told the sales for the current financial year average to how much? Average to 20 million. So mean that he was entitled to a commission of what? Of 3 million. So that commission automatically will be paid out of that what? Profit. The other item which we list here is the interest on capital. Interest on what? On capital. We have any information about interest on capital? Yes. So that information, we have it in the first paragraph where we are told that the partners were entitled to interest on capital equal to 10%. So we need to compute the interest on capital to the 3 partners. So we have the first partner who is 𝗙𝗏 𝗡𝗃, and then we have Kidore. So we are told they are entitled to interest on capital equal to 10%, and you're told that this interest on capital, I hope you can see that information in paragraph 1, the interest on capital is 10% on the fixed capital balances, 10% on fixed capital account balance. So we compute this interest on capital as 10% of the fixed capital account balances. So basically based on the partners capital what? Partners capital account balances. So in the trial balance, can you see the interest on, or basically can you see the partners capital account balances? What is the capital account balance for 𝗙𝗏? Capital account balance for 𝗙𝗏 ni ngapi? From the trial balance which we have there. The capital account balance for 𝗙𝗏, how much? How much? I need to get that figure from you. Yes, it is 58,500. So we get 10% of that. For the other partner, that is 𝗡, we have 37,000. And then finally, we have the last partner, who is 𝗙𝗏𝗃, which is 500. So we need to get now 10% of that. So this will give us 5850. Here is 3700. And here we get 5150. So those are our figures there. Yes. So then finally, what we left here is the share of a profit or loss. Now, in this case, you determine the amount to be shared, or here you have to determine whether the amount to be shared is a profit or loss. How do you do that? How do you determine whether the amount to be shared is a profit or loss? So you take the full amount here to be shared. Remember, you have said this amount to be appropriated, to be distributed to partners, to be shared among partners. So you take that amount, you less all what we have here. If you had salary, less it there. We have commission, less it there. Also less the interest on what? Capital. If you get a positive figure, is a profit to be shared. If you get a negative figure, it is a loss to be shared. So can you do that? You tell me whether you have a profit to be shared or a loss. We have a profit or a loss to be shared. We have a profit or a loss to be shared. Yes, a profit of how much? A profit of how much? Yes, I'm given a figure of 300. So that is the figure I'm given. Someone to confirm whether that figure is correct. So we have the 3 partners. That profit will be shared by the 3 partners. So you need to confirm whether the figure for profit, the profit is 75,300. Yes, so that profit will be shared among the 3 partners, 75,300, and this profit is shared among partners using their profit and loss sharing ratios. Using their profit and loss sharing what? Ratios. So we are given the profit and loss sharing ratios, or the profit and loss sharing ratio, which is 2:2:1 for 𝗙𝗏, 𝗡, and 𝗙𝗏𝗃. 𝗙𝗏, 𝗡, and what? 𝗙𝗏𝗃. So in this case, for 𝗙𝗏, we get now the total first of all here, which is 5. So mean that 𝗙𝗏 here will be entitled to a share of 2/5, 2 total. The same case with 𝗡, 2/5, and 𝗙𝗏𝗃, 1/5. So therefore, we get 2/5, 2/5, and 1/5. So that is the amount of profit to be shared by each of the partner here. So that will give us what is 75,300 divided by 5 times 3. So which will give us 45. Okay, should be times 2, not 3. So this will give us 30, 120, 30, 120, and this will be 15, 0.60. So basically, we have distributed that profit now to the partners, meaning that once you less all these items here from our amount of 91, that should give you 0. So you take this minus all these items, you should get what? 0, because what you have done is basically you have distributed that profit among who? Partners. We know that is the objective of a partnership business, to carry on business and share out the profit. So after doing that now, after sharing that profit, we can now go back to our question. And basically what we need to do is to cross off the books of accounts of the partnership by preparing the 3 accounts required in Roman 1. So those are the accounts now I want us to prepare. we start with the realization. We start with the realization account. The realization account. Realization account. Then from there we prepare the partner's capital account. We prepare the partner's capital account. Partner's capital account. So the partner's capital account, you have said this is still a ledger account, but this account do have a number of columns. We have a number of columns. So first of all, we divide it into two sides. We have the details column here, and basically columns equal to the number of partners. How many partners do we have? We have 3 partners. So other than the details column, you're going to have 3 additional columns. 3 additional columns for our 3 partners. Yes, so this now will be our partners capital account. So this is the details column. And then we have the first partner who is 𝗙𝗏&𝗔. And then we have the last partner who is 𝗙𝗏𝗄. That is the credit side. Then these are debit side. We have the details. The details column 𝗙𝗏&𝗔 and 𝗙𝗏𝗄. So that's how our capital account should look like. Yes. And then from there, we also need to have the other account, which is known as 𝗕𝗂𝘀 Limited. 𝗕𝗂𝘀 Limited. I hope you can see we are required to prepare 3 accounts. 3 accounts in what? In Roman 1. In Roman 1, we are required to prepare 3 accounts. 3 accounts. The last account here will be the account which is called what? 𝗕𝗂𝘀. 𝗕𝗂𝘀 Limited. 𝗕𝗂𝘀 Limited, we know that this is the new company. New company accounts. New company accounts. So those are basically the 3 accounts which we need to prepare here. The 3 accounts which we need to prepare here. And if now you have those accounts, yes, we can go ahead and basically close off the books of accounts of the partnership. Let's do that. Provided you can be able to remember what we record in each of the accounts. So you have to remember, like in this account, we have said, I've given you the format. We credit it with the liabilities taken over purchase consideration. What we record on the debit side are the asset taken over at their net book value. And then in this account, what we record is the partners, capital account balances, the current account. On this side, we have drawings and so on. So, but we're now closing off the books of accounts of the partnership. We go back to the trial balance which are given there. In the trial balance, we close all those accounts, all those particular accounts, starting from the first one. The first item in the trial balance is land and buildings. Actually, the first 4 items you're given: land and buildings, motor vehicle, office equipment, furniture, and fittings. We know that these are assets which were taken over by the partnership, as we have told in 0.2 of additional information number 2. Those assets, the 4 assets were taken over by the partnership. So therefore, you have said the assets taken over by the partnership, you come and you debit them in this account, but at their net book value. At their net book what? Value. So that's what we need to do. We start with the first asset, and that is land and buildings. Land and buildings. So my space is not that big, so I will use, I think, abbreviation. But for your case, write that in full. That is land and buildings. So what we need to do is to compute the net book value for land and buildings. So how do we compute the net book value? Net book value we know is equal to cost minus accumulated depreciation. Because you have said those assets taken over, we debit them there at their net book value. So what is the net book value for land and buildings? It will be equal to the cost, which we have there in the trial balance, the figure of 123,500, and we less accumulated depreciation. That is the cost, the accumulated depreciation. The accumulated depreciation is what you're given down there as a provision for depreciation. As a provision for depreciation. Provision for depreciation for buildings is 2150. So whatever you get here is the net book value. So give me those values and you try to hurry up so that we finish the question on time. So the net book value, what are you getting here? Net book value, you're getting a figure of what here? I'm given 103. And also you need to indicate here our figures are in thousands of shillings. Indicate there our figures are in thousands of shillings. So we do the same for the other item. The second item is a trial balance, which is a motor vehicle. Right, those figures in full. The net book value of motor vehicles will be equal to the cost, 8600, minus accumulated depreciation, which is down there, 54,600. So we get the net book value. Net book value, which will be how much? Which will be 26,000. 26,000. Then from there we have office equipment. The net book value will be equal to the cost, 7,200, minus accumulated depreciation, 24,400. 400, and that will give us a net book value of what? Net book value of what? Yes, what is the net book value here? I'm given a net book value of 45,800. So then below office equipment, we have furniture and fittings. So the net book value will be equal to 52,000 minus the accumulated depreciation, which is 18,500. 18,500. And that will give us what? That will give us a net book value of what? A net book value of 33,500. So basically you can see we have crossed off those particular asset account, the 4 asset account. And because now we have captured those particular accumulated depreciations in computing those net book values, we now ignore those depreciations. We go to the other items, The other item from the asset, I've said we skip those depreciations. We have captured those depreciations in computing those net book values. So the other item which we have down there is the investment. I hope you can remember there was some information we were given regarding this investment. Can you go to the additional information number 2? Additional information number 2, or basically point 1, point 1 of note 2. In additional information note 2, we have a number of points there. Point 1, we are told investment comprised equity investment, which was acquired by the partners during today. So what we are given in the trial balance as investment, we are told this was investment in shares, and we are told that each partner was to take over a portion of the investment equivalent to the profit share. So this investment will not be transferred to the new company, but rather it is to be taken by partners. And the investment had a market value of 50 million. So at the date, this partnership business was converted into what? Into a partnership, into a company. At the time the partnership business was converted into a company, this investment had a market value of 50 million. And therefore, when the partners are sharing those investments, they will share them at their current market value of 50 million. So how do we account for those particular investment? Maybe I can prepare an account here so that you understand how we prepare those, how we account for those investment. We can prepare this account, which is called investment. So this investment or this account is an asset account, and therefore the opening balance which we have in the trial balance is a figure of 44,800. So we record those particular assets here at their net book value. So once we have some assets which are not transferred to the new company, but rather taken over by partners, we say generally, in terms of how we account for that, we credit that account. For example, in this case, we're going to credit this account with the 44,800 to cross off that account. And then the other entry will be in the partner's capital account. We come and we do what? We debit that account. Remember, we have said everything here, we account for it using the concept of double entry. But we know that this particular investment at the time they were shared, they had a market value of what? Of 50. So the partners will share this investment at this value. At this what? Value. And we are told they will be shared among partners using their profit and loss sharing ratio, because you are told each partner will take over a portion of the investment equivalent to their profit share. So we know the profit share here for 𝗙𝗏, 𝗡𝗃, 𝗙𝗏 is 2/5. 2/5 for 𝗙𝗏, 𝗡𝗃 2/5, and 𝗙𝗏 1/5. So they are going to share this investment at this value, at the value of what? 50. So this will give us 20,000. I hope you can see my figures. They're small here, but I hope you can be able to see them. So these also will be 20,000. What about 𝗙𝗏? 1/5 of 50. This will give us what? 10. So those investments will be shared at a value of 50. But we know that the investments, they have a value of what? 44,800. So meaning that this particular investment, we can say their value increased. What is the difference between 44,800 and 50,000? First of all, what is that difference? The difference between 44,800 and 50,000, is it 52? Is it 52? Yes, it is 52. So this 52, we say is a gain on revaluation. Is a gain on what? Revaluation. So how do we account for that? So first of all, what you need to note is that this particular investment, we have said they will be shared at a value of 50. And therefore, this account, the partner's capital account, will be debited with an amount of, for example, 𝗙𝗏 took over investment having a value of 20, 𝗡𝗃, the same 20, but 𝗙𝗏 10. But now, when crossing off this account, we are going to cross it off at that amount of 44,800. So remember here, when accounting for all these, we follow the concept of double entry. So what you're saying is that this account, the partner's capital account, you can see it has been debited with a total amount of 50 million. So this and this and this is 50. But now the investment account is credited with 44,800. So you can see, I hope you know what the rule of double entries requires. Every transaction must affect at least two accounts, and the amount to be debited should be equal to the amount to be credited. So you can see we are debiting this account with 50. This account, we are crediting it with 44,800. So this particular gain, which is 52, who can tell us which account or where are we going to record this gain of 52? That gain, that increase in the value of the investment, to record what? Because lazima to record mahali fulani in a certain account. That amount of 52. Where are we going to record it? Any idea? Any idea? Any idea? Now this particular gain, we credit it now in the account called realization. We credit it in the account called what? Realization. So that particular gain, we come and we credit it here, the gain on investment. The gain on investment, which is 52, such that by the end of the day, we will have complied with the rule of double entry. Sasa, yes, that's how we account for those particular investments which were shared among who? Among the partners. Among who? The partners. Sasa, we have debited the partners' capital account with 50, credited investment with 44,800, and then 52, which is a gain. We have credited that in what? In which account? In the realization. So that is all. So let's move to the other item. Below, we are still in the trial balance. I've said tuna cross hizo items zote. Tumefunga asset, tumedina investment. Below investment, what do we have? We have goodwill. We have goodwill. I hope you're together. Now for goodwill, kuna point tumeambiwa tumepewa ya goodwill in note number 2. In note number 2, can you go to note number 2? Point 2 of note 2. Point 2 of note 2, the last point down there. Although in point number 2, note 2 of point 2, we are told, we are given first of all the assets which were transferred to the new company, and we are given those assets including land, motor vehicle, office, furniture, inventory, account, current liabilities, and then the last point of note 2 there, we are told goodwill was considered valueless and was therefore written off. Now, this goodwill which was considered valueless and was written off, how do we account for that goodwill? How do we account for that goodwill which was considered valueless and therefore was written off? I gave you an accounting entry for that yesterday. Tulisema, how do we account for that? Who can remember? We said we debit which account? First of all, automatically we have to credit the asset account because tunataka kufunga hiyo account ya goodwill. Hiyo account iko na debit balance. Hiyo account ya goodwill iko na debit balance. So tunataka kuifunga, tutai credit, and then we debit now the partners what? Capital account. And basically that asset should be shared among partners using their profit and loss sharing ratio. So we credit this account. So can you share out that goodwill using the profit and loss sharing ratio of partners? 2/5, 2/5, and 1/5 for 𝗙𝗏, 𝗏𝗃, and 𝗙𝐏𝐻. So 2/5 times 26,000. 26,000 times 2 divided by 5. So I'm getting what? Guys, you're not giving me these figures. If you don't give me the figures, tutashinda hapa. If you're not giving me the figures, tutashinda hapa. So need to be chap. So that is what I'm getting. So that goodwill was not transferred to the new company, rather it was written off. That's how we account for those assets. Then let's move to below the goodwill. We have the other asset, which is inventory. So basically inventory we know as per note number 2 is one of the assets which was transferred to the new company. That's what we know. So, and being an asset which was taken over by the company, we need to do what? To debit it here. Remember, this account is debited with all assets taken over by the company. So inventory was taken over by the company. Its net book value is 31,200. Below inventory, we have account receivable. Account receivable still is an asset. If you go to note number 2, is still another asset which was taken over by the company. So we have account receivables. It has a book value of 31. Okay. Yes, it has a book value of 25,400. So and then below account receivables, what do we have? We have bank overdraft. Bank overdraft is a liability. And basically, if you go to the additional information number, to the additional information number 2, point 2 of note 2, we are told all current liabilities were taken over by the company at their book value. So therefore, bank overdraft, which is a current liability, was taken over or was transferred to the company. What you have said is that all the liabilities which are transferred to the new company or taken over by the new company, they are credited in this account. So therefore, bank overdraft, being one of the liability which was taken over by the company, it is supposed to be credited in this account. There is something I think I've skipped there. That is account payable. Let first of all we account for account payable. Account payable still is a current liability, and it was taken over by the new company. So we credit it in this account. All liabilities transferred to the new company, they're supposed to be credited in this account. Below that, we have bank OD, bank overdraft, still a current liability which was taken over by the new company, 17,550. Below that, we have accrued expenses. Accrued expenses still, these are current liabilities. They were still taken over by the company, and the value for that is what? 4,000. So all liabilities taken over by the new company, they are supposed to be credited in that account. And then from there, what we have? We have the partner's capital account. Now, the partner's capital account, that should be recorded in this account. And we said it should be recorded in this account on which side? On the credit side. So the partner's capital account, we record it here. Actually, we can just refer to that as the opening balance in this account. The opening balance in the partner's capital account for 𝗙𝗏, 58,500. For 𝗡𝗃, that is 7,000. And then for 𝗙𝗏𝗃, we have 31,500. I hope you can see there is nothing we are skipping. We are basically crossing off all those accounts. So then below that, what we have? We have what? We have net profit. Now the net profit, we will not record it here because we know that that net profit has been distributed to partners. So what we record now in this account is what now we have been able to distribute to each what? A partner. So basically anything which a partner is entitled to, all these particular appropriations, you see all these appropriations, they are supposed to be recorded in this account on the credit side. On the credit side, all these appropriations which the partners are entitled to, we record them in this account on which side? On the credit side. Sasa? Yes. So let's start with the salary. Do we have salary? No, but if we had a salary, it should be credited here. So what we have next is a commission. Commission. The partner is entitled to that commission is 𝗙𝗏𝗃. How much is that? 3,000. Then we have the interest on capital. Still, we record it in this account on the credit side. Interest on capital for the first partner, who is 𝗙𝗏, 5850, 𝗡𝗃, 37, and the other partner 31. And then finally we have the share of profit. So we have 30,120, 30,120, and 15,060. So we have recorded all those items there. All those items we have recorded them here in that account. So then from there we have drawings. We go back now to the trial balance. We go back to the trial balance. In the trial balance, I think we have dealt with the profit now. We go to the next item. There is nothing we are skipping here. Tunafunga hizo account zote. So the other item is drawings. So drawings, that one should be recorded in this account on the debit side. Remember, I've given you the format of what should be recorded here. So the drawings for 𝗙𝗏 is 78. Drawings for the other partner, who is 𝗡𝗃, 65, and 𝗙𝗏𝗃, 39. And then finally, we have the partner's current account. So those partners' current account, you can see all of them. They have a credit balance. So we come and we cross them off to this account. But there are some cases whereby you may be given a partner current account having a debit balance. If a partner current account has a debit balance, you record that debit balance on this side. So you always have to check the balance of the current account. Come on, debit balance, you record it on the debit side. Come on, credit balance, you record it on which side? The credit side. So we have now the current account. So for the first partner is 20,800. Then we have 18,200. And then we have 13,000. 13,300. Actually, now we are through. We are through with the recording all those items in the trial balance, and I hope you can see now we have been able to cross all those particular accounts which had balances at the end of there. So maybe what we just need to do is we go through the additional information, we see whether there is something which you have not been able to capture here. So I think in note number 1, we have accounted for commission. Note 2, we have accounted for what? For the assets which were taken over, the liabilities which were taken over, the goodwill which was written off. But there is something we are yet to account for in point 3 of note 2. Point 3 of note 2, we have the purchase consideration, which was agreed as 250. That purchase consideration agreed, if you can remember, we said it should be credited in this account. Purchase consideration, which is 250 million, but take into account our figures at 1,000 of shillings, we recorded there as 250,000. We credited in that account, then we debited in this account. Remember, these are all these journal entries I gave you yesterday. So we debited in this account. So this we can just say is purchase consideration. Is purchase consideration of how much? Of 250,000. And all our figures are in 1,000 of shillings, 250. So we have accounted for that purchase consideration. Then what we have in note number, the last point of note 2 is the partners are to become shareholders, and we are told they will be paid by the new company in terms of being issued with the shares. And then the last point, note 3, that is that it will be taken into account when opening the books of account of the company. That is a transaction in the books of account of what? Of the company. So I think we are done. We are through with the crossing of the books of account of the partnership. Now what we need to do here is now we balance off these accounts. When balancing this of this account, we always start by balancing this account, because you have said in this account we may have a balancing figure on this side, which is basically what? A loss on disposal, or you can have a balancing figure on this side, which is a gain on disposal. So that is the first account which you balance off. And then the balancing figure here, which is a gain or a loss on realization, not on disposal, sorry, on the realization, you share, or that profit or loss should be shared among partners using their profit and loss sharing ratio. And you bring it here. If a gain on the realization, you credit it here. If a loss on the realization, you debit it there. And then once you are through with that account, you come and balance off this account, of which the balancing figure in this account should always be on this side, and it represents the amount to be paid to the partners. And that amount by the end of the day must be equal to 250, must be equal to the agreed, to the purchase consideration agreed. So can we first of all balance that account? So get the total on the debit, get the total on the debit side, get the total on the debit side, and I add what we have on the credit. What we have on the credit, we have 52 plus 62,400 plus 17,550 plus 4,000 plus 250,000. 250,000. So what are you getting on the debit side? On the debit side, I'm given a figure of what? 265,400. Now I need to get these figures from you. If you don't give me the figures, I can't be able to move. Yes, the total on the credit is 339,150. What about the total on the debit? So we'll work with the figure which I'm given there. To what? 265. 265 what? 250. To 65 to 50. So mean that the side which is more is this side. It means that we have a balancing figure on this side, because this side is mingi than this one. So the balancing figure itakuwa side gani? This side. So in this case, a balancing figure on this side is a gain on realization. Is a gain on realization. Now that gain on realization is supposed to be shared among our 3 partners. Our 3 partners include 𝗙𝗏, 𝗏𝗃, and 𝗙𝗏𝗃. I will just use the first letter, but make sure you write that in full. So how much will be the gain? It is what we have on the credit side, 339,150 minus what we have on the debit, 265,250. So I'm getting a gain of 73,900. Now this gain is supposed to be shared among partners using their profit and loss sharing ratio. So the profit and loss sharing ratio for the first partner is 2/5. So we divide that with 5. We divide that with 5 times 2 times 2. I'll get 29,560 for the first two partners. 29,560. And then 14,780. So that gain on realization, we debit it in this account, then we credit it in this account. Remember, we record everything here using the concept of double entry. So we have the gain on realization for the first partner is 25,560, 29,560, and 14,780. Yes. So basically we are through with that. Now what we need to do we need, I hope those figures are correct. Someone need to confirm those figures are correct. I'm not getting any figures from you. And these figures correct? Is the gain 73,900? Okay, so if the figures are correct, then what we need to do, we need now to come and we balance of this account, the partner's capital account, and basically the balancing figure in this account, which should be on the debit side or which will be on the debit side, is the payment to the partners. So the balancing figure which we have here should be on this side, and it is the purchase consideration. So it represents the amount of money to be paid to each partner. Now that amount to be paid to each partner, by the end of the day, we have said it must be equal to this total of 250. So therefore, the amount to be paid to each of the partner here will be debited in that account and then credited in this account. So therefore, what we are going to have here is the payment to the partners from their capital account. From their capital what? Account. So we are going to have the payment now to be made to the three partners, 𝗙𝗏, 𝗏𝗃, and the payment to who? To 𝗙𝗏𝗃. So what we need to do is to balance this account. So how we balance, in terms of how we balance, we get the total, for example, for 𝗙𝗏𝗃 on the credit side, and then we less what we have on the debit side, still in the column for 𝗙𝗏𝗃. Sorry, for 𝗙𝗏, sorry. So we get the total on the credit side or basically the total on the credit side for the first partner, who is 𝗙𝗏. So we have 58,500 plus 5850 plus 30,120 plus 20,800 plus 29,560. And then we less what we have on the debit side for 𝗙𝗏. We have 20,000 minus 10,400 minus 78. So I'm getting 106,630. So I hope that is the same figure which you're getting. So we debited here, we credited here 106,630. We do the same for 𝗏𝗃. Get the total on the credit. That's what we have on the debit. We have 37,000 plus 37 100 plus 30,120 plus 18,200 plus 29,560. Yes, I hope that computation is okay. 3,700, 30,120, 18,200, and 29,560. Minus what we have on the debit, which is 20,000 minus 10,400 minus 65. So I'm getting a figure of 81,680. Okay, yes. So we then credit that here. And then we do the same for Kidore. So what do we have on the credit? 31,500 plus 3,000 plus 3,150 plus 15,060 plus 13,300 plus 14,780 minus what you have on the debit, and that is 10,000 minus 52 minus 39. So I'm getting 61,690. 61,690. Yes. So basically that is now the amount to be paid now to each part. Now, once we do that, this account here should automatically balance. Can you add all this? You see whether it will give us to 250, because I've said this payment to the partners should be equal to 250. So let's confirm whether that will give us 250,000, 81,680 plus 106,630. So that is giving us what? All this is giving us 250,000. So basically what we have on the debit side. So it automatically means that now we have successfully crossed off the books of accounts of what? The partnership. Those are the three main accounts which are prepared to cross off the books of accounts of what? The partnership. And now we are through with the partnership. So we go to Roman 2 now. We go to Roman 2, whereby we are required now to prepare the opening statement of financial position of the new what? Company. Now, before you prepare that opening statement of financial position of the company, there is an account which we must prepare, and always that account must be prepared to determine whether the company took over the business of the partnership at a goodwill or a capital reserve or negative goodwill, and that the account is known as the business purchase account. So that is the first account we need to prepare before you proceed and prepare what is known as the opening statement of financial position of what? Of the company. So let's prepare that account, business purchase account. Business purchase account. To prepare this account is very simple, provided you can be able to remember the format. Yeah. So what do we record in this account? This account one, we said we credited with the assets taken over, taken over at their fair value, the assets taken over at their fair value. And basically we have those particular assets. And then what we have on the credit side, sorry, on the debit side are 1, the liabilities taken over, and 2, the purchase consideration. So can we first of all record the assets now which were taken over? And I think instead of recording those assets separately, because this account is not required, we are doing it as part of workings, we can get the total value of the assets taken over. We can have that summary here. Assets taken over, because we have the assets which were taken over from the additional information number 2. The assets which were taken over 1 include the land and buildings. And what we have said is that in the books of accounts of the company, we account for this particular asset at their fair value. Fair what? Value. So in this case, land and building is per note number 2 was taken over at a value of 115,000. So I want us we get the total value of the asset which were taken over. We have motor vehicles which were taken over at a value of 25,500. We have office equipment taken over at a value of 43,500. We have furniture and fittings, or furniture and fixtures, which were taken over at a value of 29,550. Then we have inventories. Inventories were taken over at a book value less 5%. Less 5%. So what does that mean? It means that the inventory were taken over at a value equal to 95% of the book value, because you are told they were taken over at book value less 5%. Is the same as saying that the inventory were taken over at a value equivalent to 95% of the book value. We know the book value of the inventory here was 31,200. 31,200. So we need to get 95% of that. Then below the inventory, we have account receivables. And account receivables were taken over at book value less 2.5%. So in other terms, we can say that the account receivables were taken over at the book at 97.5%. Remember, 2.5 is 2.5. 2.5. So 2.5, you less that from 100, will give us 97.5 of the book value. 97.5 of the book value. The book value, we have it here, 25,400. And then what else do we have? Yes, so I think these are the only assets which were taken over by the company. So can we get those final figures? The inventory, what are you getting there? 95% times 31,200. 20 what? 29,640. 640. What about receivables? 97.5% of 25,400. So I'm getting 24,765. 765. So those are the assets now which were taken over. These are the assets which were taken over by the company. So now what I want you to get is the total value of the assets which were taken over. That's now what we need to credit in our account here. We need to credit that in this account, assets taken over at the fair value. At the fair value. So what is the total value there? The total I'm given on 84,005. On 84,000 what? 005. So total asset taken over at their fair value. That's what we credit in that account. And then this account we debit it with the liabilities which are taken over. The liabilities which are taken over, and also the purchase consideration. And also the purchase what? Consideration. Purchase consideration we know is 250. Purchase consideration hapa tunajua is 250,000. We don't need to compute that. Now I'm given different figures. Now addition is a problem. Is addition really a problem? I'm given different figures here. Sharon ananipea 184. Okay, yes, I think I've given figures which are 267,995, 267,995, 267,995. Yes, 267,995, 267,995. So that is now the total fair value of the assets which were taken over. That should be credited in that account. Then what do we debit in this account? One, purchase consideration, and two, the liabilities which were taken over. Liabilities taken over. Liabilities taken what? Taken over. So in our case, we know the liabilities which were taken over. Where can we get those liabilities even without going back to our question? So the liabilities which were taken over are in this account, the realization account on the credit side. And basically, we know we have these three liabilities which were taken over by the company. We have said whenever the liabilities are to be taken over by the company, they are taken over at their book value. Liabilities are never revalued. You cannot revalue liabilities. So can we add those three liabilities? 62,400 plus 17,550 plus 4,000. 4,000. I'm getting a total figure here of 83,950. 83,950. Yes. So what then we need to do? We try to hurry up because I know by 6 there is another class which will be conducted using maybe the same Zoom account you're using. So we need to finish by 4, not 6 rather. So can we get the balancing figure? Remember, you said once you record those items, a balancing figure on that side is a goodwill. A balancing figure on this side is a capital reserve. Is a capital reserve. So what do we have? We are automatically going to have a goodwill. A goodwill of how much? So we have 83,950 plus 250,000 minus 267,995. So I'm getting a balancing figure there of 65,950 what? 8. So basically I've said these are goodwill. These will be taken or recorded in the statement of financial position of the company as a component of asset. So, and I think with that now, we need to proceed and prepare the statement of financial position of the new company as required in Roman 2 of that question. A statement of financial position of the new company. So we have the title here. We know that the new company, the name of the new company is 𝗙𝗵𝐻 Limited. That is the name of the new company. And this is the statement of financial position. And is at 1st of October 2017, because we know that is the date when the conversion took place. So what do we record? The first item to record here are non-current assets. Non-current asset. And basically these are free marks because you have almost everything to be recorded here. So we know the assets which were taken over by this company. These are the assets which were taken over. So the non-current assets include land and buildings, motor vehicle, office equipment, furniture, and fittings. We come and include them here, and we should not forget the goodwill. So let's record those assets which we have there. So we have land and buildings. Land and buildings. And actually you can see all these items, you're getting them from additional information number 2 of that question. Land and buildings were taken over at a value of 15. We have motor vehicles. Motor vehicles which were taken over at a value of 25,500. We have office equipment taken over at a value of 29,550. We have furniture and fixtures taken over at a value of what? Okay, for office equipment should be 43,500. This should be 29,550. Then for inventory and account receivables, these are items of current assets. Current assets. So these are the only non-current assets, but we should not forget this goodwill. That goodwill I've said is an asset of the new company. Goodwill, which is 65,958. Yes. So then from there, next we proceed and record current assets. Record current asset. We have these two assets here, inventories. But for inventories, we need to take into account the information we have in note number 3 of that question. So can we quickly go to note number 3? So we know the inventories which were taken out from the partnership, they had a value of 29,640. But in note number 3, additional information number 3, there is something we are told here. Let's go to the additional information number 3. We are told upon incorporation of the new company, the new company issued debentures at par value carrying 14% per annum, or the interest of 14%. The cash proceeds, or the amount of money now received from the issue of debentures, amounted to 50 million and was used to purchase additional inventory or additional stock of raw materials of 15 million. So meaning that other than this stock or this inventory which was taken from the partnership, the company acquired an additional inventory of 15 million. We need to add it to this inventory. That will give us what? 44. 44 what? 640. 640. Are we together? Yes. And also we are told the accrued expenses were settled in full. So mean that when recording the current liabilities, you have to recall that there were 3 liabilities which were taken off from the partnership. So accrued liabilities were settled. And in that case, it means that there is an account which you also need to prepare here. Before we proceed to record equity and liabilities, there is an account which we need to prepare here in the books of accounts of the company, and that is the bank account, because you can see that this company here raised some amount of money. So, and also from the amount of money which was raised, the number of transactions which were taken over, the number of transactions which were undertaken by the company. So automatically we must prepare this account to determine the new balance. The first thing we record in this account is the bank overdraft. I hope you can remember there was an overdraft which was taken over by the company from the partnership. That overdraft, we record it in this account as the opening balance in the account, but on the credit side because it's an overdraft. How much was that overdraft? That overdraft, you can get it from the realization account on the credit side, though it is also given in the trial balance. And the overdraft is what? Is 17,550. So that is the overdraft. Then what we also know that is from the additional information we have in note number 3 is that this company issued 14% debentures and the company received a cash of 50 million. So once the company issued debentures and the company received money from the issue of debentures, that amount should be debited in this account, and then we credit it in an account called 14% debentures. Kwa hivyo tukirecord na current liabilities hapa, tutakuwa na kitu inaitwa 14% what? Debentures. Then we are told this amount which was received by the company, 50 million, it was used to acquire inventory. So in other terms, the company paid for inventory. So the inventory which were bought automatically are supposed to be credited in this account. We know the company bought inventory which had a value of 15 million. That should be credited because money received in the bank account should be debited. Payment should be what? Credited. So other than the company purchasing that inventory, the company also paid the accrued expenses which were taken off from the partnership. That's what we also told in note number 3. So the accrued expenses which were taken from the partnership, can you remember their value? Can you remember they had a value of how much? Those accrued expenses, you can get those accrued expenses in the trial balance or in the realization account of the credit side. They had a value of how much? 4,000. Can you see that? Yes. And then now what we need to do is we need to determine the new balance in that account, the new balance. So what do we have on the debit side? On the debit side, we have 50. What about the credit? 17,550 plus 15,000 plus 4,000 plus 4,000 plus 4,000. Yes. So meaning that we have a balancing figure on this side of how much? Because the total on the debit side is more. We have a balancing figure of 13 450. And basically what is this? 13,450. This is now the money which was in the bank account of this company. 13,450. So therefore, this being the money which was in the bank account, because you can see out of this 50 million, the company paid that overdraft, the company paid for inventory, the company paid for accrued expenses, and the company remained with a cash of 13,450. That amount now is a current asset. Is a current asset because this is the money in the bank. How much is that? 13,450. And I forgot to record the receivables, and I've done away with that figure. The receivables was how much? Someone to give me this figure. Was it 26 something? Receivables from this summary which we had there of the assets taken over by the company. 24 what? 765. Yes, so I think we are through with the recording the assets. So what we need to do quickly, we need to get the total here. So get the total assets before we record equity and liabilities. Total asset, you add all this. And basically, I think, yes, you add all this, give me the total. Add the total asset quickly. So we need to wind up 65,958 plus 44,640 plus 24,765 plus 13,450. So you're getting a total of what? And this goodwill, the value for goodwill, is this figure correct? That figure for goodwill was how much? This one, this figure is not correct. The figure of 955, 955. So the correct figure here should be what? Should be 362, 362, 360. Yes, 362, 360. Yes. So next we record now the equity. Equity. So equity, what we have here is the ordinary share capital. There is a point you have to remember that this amount of money purchase consideration of 250, it was paid to the partners in terms of being issued with the shares. That information, we have it in note number 2, the last point of note 2. Last point of note 2, we are told the partners were to become shareholders. The company issued ordinary shares at a par value of shillings 10 to the partners to satisfy the balance due to them. The balance due to them is the amount which was to be paid to the partners. We know the total amount paid to all partners was equal to 250. So this amount was paid to the partners in terms of being issued with the shares. So therefore, the ordinary share capital of our new company is 250. Is to what? 50. That is now what we include here. 250,000. So we don't have any other item of equity, but the other item you may also include here is a capital reserve from this account. If you get a capital reserve there, we say that is a component of equity. You come and you include it there, but we don't have a capital reserve. Finally, or basically next we record liabilities. We record the non-current liabilities. Non-current liabilities. Non-current liabilities. So we know that this company never took over any non-current liability from the partnership, but you have to remember that this company issued 14% debentures. So that will be the only non-current liability of our new company, 14% debentures, and we know that those debentures, they had a value of what? 50. Finally, we record the current liabilities. The current what? Liabilities. Now, This company, what we know from the realization account on the credit side, this company took over three current liabilities. The bank overdraft, we know the bank overdraft from this account. This bank overdraft has fully been settled. It will not appear here as a liability. Two, the company also took over accrued expenses. We know accrued expenses have been paid. Is that correct? Yes. So therefore, out of the three liabilities which were taken over from the partnership, the only liability which is remaining is account payable. Account payable, and basically that is what we are going to record here. And we know that the account payable was taken over at the book value. So the account payable, the value for that was what? Was 62,400. 62,400. So that is the only current liability of the company. We get the total now. We get total equity and what? Total equity and liabilities. Total equity and liabilities. Basically, we add 250 plus 50 plus this, and that should give us 362. 362 what? 400. Is it 362, 400? Yes, 362, 400. So we have a difference of what? Of 40,000. We have a difference of 40,000. What is this 40,000? So the goodwill was supposed to be what? 65,995. So if you add, so goodwill was supposed to be 65,955. And therefore the correct total here should be what? Or 9, okay. Okay. 995. So the correct total here should be 3 what? 362, 400. Yes. Should be like that. So basically that is it, that what was required in that particular question there. The question on conversion of partnership into a company. Into what? Into a company. So we are through with that question there. So what I'll do, I'll give you another question. I'll give you another question so that you attempt it. Actually, we have so many questions on this, but maybe you're going to look on additional questions during our revision. Because of time, we will only tackle one question, but maybe you're going to look on more questions. So let me share the question which I'll give you as an assignment over the group there, over the class WhatsApp group. So once I get that question, because I know we need to add. Yes, so I'll be able to share that question with you, but in the meantime, we stop at that particular point. I don't know whether there is any question before we wind up. Any question? Any question? I think there is none. Okay, so let's stop at that point for today. See you next week as we start on a new topic, but I'll be able to share that question with you as an assignment. So otherwise, have a nice evening.